So we're looking at all the commodities lately, and the question that keeps coming up over and over again is cocoa. Everybody wants to know what is going on with cocoa. And, Kevin Green is here, has a really good understanding of the commodities markets. We're going to ask him that question. Going through some performance, though, just year to date, we're looking at cocoa up 136%. The Nikkei is up, which is Japan index, which is up 22%. Orange juice is up 20%. Oil is up 16%. Cotton is up 15%. Gasoline 13%, almost 14% actually. And lean hogs up 13%. Like it's been some of the commodities are really starting to run. And so we'll start out with cocoa. Kevin, everybody asks the same question over and over again, and it's what's going on with cocoa? What's the fundamental reason that it's all the way up here? You're the guy who could possibly explain it if anybody else. For me, I'm just kind of going, hey, the trend's up, ride the trend. I don't really know how it got all the way up here. Can you explain, Kevin?
Yeah, so there's two different dynamics. So let's talk about the actual fundamentals of the cocoa contract itself. So what's happening right now and what's been happening for a very long time actually is that contract's actually fairly liquid. So you're having more obviously buyers than sellers in that contract, but it's also creating a situation where liquidity is now coming into it when traditionally it's not that liquid. And so you're starting to have this basically this domino effect when it comes to prices moving to the upside here. Now, if you're looking at the actual landscape of cocoa, what's actually occurred here is over the last couple of years, we've had an experience, especially in West Africa, an issue with drought and very bad conditions when it comes to trying to grow cocoa in a sense. And actually, if you think about it, I believe this is either the third or fourth year that they've had these really dramatic weather events that have been putting pressure on cocoa. And so with La Nina and El Nino, those two different dynamics continue to strain the crop. And now what we're actually seeing is not only is the crop being strained and we're having lack of supply compared to pseudo demand that is out there, but now the last, let's say $100 of this move to the upside, $150 of this move to the upside has actually been a situation where the farmers are now hoarding their stockpile and not actually bringing them to market. And that actually is causing or has the potential risk, and is actually happening, the risk of actually causing the physical contracts to be broken. And so it's not only just the fact that weather events have strained the crop in general, which it takes 3, 4, 5 years to be able to replenish, but now you have a situation where the farmers themselves are actually hoarding the supply and potentially defaulting on some of these already pre-planned contracts that are out there. And that's also creating this move to the upside. Now, one thing to also note is the weather events are not supposed to abate anytime soon. I mean, we are supposed to see some decent weather events this week and next week when it comes to West Africa. When we're talking about that, the two major producers are going to be Ghana, and then also you have the West Ivory Coast. So those are going to be the two major producers right now. And those are the ones that are experiencing the high winds, the drought conditions. And then when we do have rain there, and precipitation, it's a lot of it. And you don't have this very normalized cycle of weather events, which is, once again, you're getting too much rain in certain respects, then it's drought conditions for 3 months, 4 months. Then you have the wind, and the wind conditions themselves can actually tear up the crop. So there's a lot that's happening on the fundamental side, the actual physical structure, compared to the futures contract. Last thing I will say, you are seeing a little bit of disconnect between the U.S. futures contract and what's actually happening out in London. Mm-hmm. So in London and in the European Union, which is a major consumer of cocoa, right? They're actually having an issue with transporting cocoa out because of the Red Sea conflicts. So not only do we have, let's say, a supply shortage here in the United States and across the globe in certain respects, but the major hubs of this product are also seeing gluts, and you're not able to send it to the people that are wanting to actually buy it and deliver it. So the supply chain's messed up, the crop cycle is messed up, the weather events are also messed up, and then you have speculators in this market that continue to bid up a non-liquid contract. All of that is enough tender to spark the flame for this contract to the upside and to continue to move.
Yeah, I mean it's wild for me. At the beginning, it's a very interesting trade for me because it's been years of chop. Like there was so many. We were just talking about it on another video just earlier today, which we were talking about the fact that NIB, which was the cocoa ETF, went offline right before this move started to happen. Also, a lot of trend followers. Like people like me, were very systematic. We read the price action when we get a breakout, we really follow it. And what the cornerstone of our systems are is that we don't really believe we can understand what's going to happen with each market all the time. And because we don't believe that, we take signals. So we back test, we try to put the probabilities on our side, and we enter and exit trades. And so if you look back over the last 10 years, cocoa has been a very choppy market. So a lot of them, even though like the point of being a systematic trader is to have diversification, be across a lot of different markets, a lot of different assets, a lot of the trend following and systematic traders took it out of their systems and strategies because it was such a choppy, hard to trade market. And most of the time, this is when capitulation happens. And this is where the bottom starts to come up. So as we were seeing back then, everybody gets out of it. People say cocoa is not a really good trade anymore. Funds get out of it. Big hedge funds, trend followers, everybody got over it and they were done with it. And the next thing you know, this is when those big moves happen. This is across all markets. This is something I think some people, when they hear commodities, they're like, oh, I can't really use this in any other market. It's like, no, every market works like that. Every market has a capitulation part. Think of 2009 in the stock market's the greatest example ever. At that point, nobody thought the market would go up anymore. We were going to be in a bear market forever. There's people who are converting all of their money into gold and whatever to get out of the market. Next thing you know, in March 2009, the market bottoms and doesn't look back for many, many years. We've never touched anywhere near that low ever again. So you just have to really understand that that's kind of a principle across all markets. And here, what we'll see at some point in the cocoa market is we will see capitulation at some point. Yeah. But like Kevin's saying, we're seeing the fundamentals are actually kind of backing up the price action at the moment, which is pretty wild. But I haven't seen many trends. I was trying to think of if I've ever seen a trend in the first 3 months of a year go up this much, even have a triple digit return. And I don't know if I ever have. I looked back and I found some interesting ones. Natural gas had a couple. But this at 130% already, it's wild.
Yeah, I would say maybe the closest one that has had a move like this, man, it has to be what, 4 or 5 years ago, probably a little bit more, actually probably a little bit more, maybe like 8 years ago with sugar. Remember we had that sugar rally that was doing kind of the same thing. I don't think it was as aggressive as this one. The pullback was a little bit quicker, to say the least. So I would say this is probably the longest standing physical that we've seen this type of rally, as well as the fact that, once again, it's not a very liquid contract. And a lot of people that trade these illiquid contracts, and when I say illiquid, what do I mean? I'm comparing the liquidity to what we typically will see for this market, right? So you have farmers, you have producers that'll trade this market, right? They can kind of maneuver around and they have a cash product that they're trying to deliver here. But when you have a product that doesn't see that much activity, and then you have this huge influx of retail flows and managed money flows, that's where it kind of disconnects the whole market. And that's where I say illiquid comparatively to who's actually trading it right now. Same thing with sugar, right? Sugar markets can be all good and dandy, but as soon as you say, ethanol demand is going up in Brazil, and so now you're seeing this huge demand when it comes to sugar, and everybody's eating candy now, whatever. Mm-hmm. Usually that's when you start seeing the retail flows come in, and that's where you see this domino effect. But you're right. I mean, once this does back off, and this is going to be hard to really back off too, because it takes 3-4 years to be able to replenish the supply that is out there, and then also the damaged crops that have been impacted over the last couple of years. So this will take years. But even the most ardent bull in cocoa right now is saying, hey, trend is your friend, but it is completely disconnected from the true supply demand fundamentals that are out there. Yes, there's some issues, but now they're thinking it might be a little bit overextended. That doesn't mean that it has to reverse, right? As you're kind of talking about, you'll see the key trends, and usually the key trends are what? Open interest decreasing. Open interest decreasing and prices still advancing. That's one thing that we see in futures markets, right? So that could be another thing that actually does occur. Now, that just shows exhaustion in the market. You can have open interest decreasing. You can have volume decreasing. That's another indicator in futures markets that something might be a little bit exhausted. You have the price dynamics too, right? Prices start to move to the downside, volume starts to increase. That's a bearish trend. Prices move to the downside, open interest starts to increase, right? Increasing open interest, downside move tends to indicate that short sellers are getting in the market. So if you're trading, there's different ways to be able to identify reversal patterns. Trust price over all of those dynamics that I just told you, but those are really good key indicators for physicals like cocoa, sugar, lumber, those that have traditional markets that, the players that play in it, they know, you know what the average volume is. And then once those dynamics start to correct a little bit, that's when you would see a reversal. I don't think there's a reversal yet. And unfortunately, I think there's going to be a lot more ETF and money, managed money flows of people that are having a little bit of a FOMO feeling before we see a pullback.
Yeah, I mean, it's well said, and I think one thing that also we should talk about a little bit too is we'll take a couple minutes on this, but we're on these talks from time to time, and Kevin will bring up something, and somebody will always have a conversation about, well, why are you talking about risk? And honestly, like, our job as traders isn't to just think about the upside; it's risk management, because the way the math works, if you look at drawdown math, for example. A drawdown means when you're anything under equity highs. So if your pullbacks are around 10%, 20% even in your equity, you can come back from that. That's pretty easy. If you have a pullback of 50%, though, you have to make 100% to get back to even. That's just even. So really, we always have to be thinking about the downside. Whether I'm in the trade, I'm long cocoa, I also have to constantly be thinking about, when am I going to get out? What's my exit signal? I know all these things already. I know them before I get in. That's the only way to trade, really, is to know it before you get in. But you have to always be thinking about the risk that you can have as a trader. That's everything. Paul Tudor Jones said it best, which was, the biggest thing he's trying to do is protect his ass. Like, it's really you got to do that, because if you're sitting there and you're, he has a great analogy which he talks about, like, he falls off a boat and his rear gets cut up by a boat motor. And as he's talking about this, he's saying, like, this is kind of like an analogy for trading. And it's like, yeah, basically, like, it does make sense, because if you have these pullbacks, you can't get back to equity high. So you need to understand, where's the risk? What type of trader are you? I'm a long short fund. I can go long and short all the time, so I can hedge myself that way. Some people will buy put options to hedge. Some people do other things. Like, once again, the trend is your friend, but also anything can happen. So you have to be ready for that.
Yeah, I completely agree with you. And then when you're looking at this market, it's a little different when you're talking about physical commodities too, right? When you're trying to hedge, a lot of the things that we talk about hedging products for, I mean, a lot of people don't trade, commodities, but when you're talking about physicals, you also have that the pseudo assignment risk. And so that's also another way that you have to look for products that have liquidity, option series that have liquidity. And sometimes when you have these type of runs, depending on the product that you're trading, you can buy out of the money put, or you can buy puts to be able to hedge downside risk. You could do put spreads, right? You could buy 3 standard deviation put spreads to be able to offset that put cost, because you don't want to eat in too much into your alpha. And then you have the strategy of selling deep in the money calls. And I hate saying it, but it is a way for you to be able to protect. If you are long a contract, you can sell something that is deep in the money. If you feel like there might be a lack of liquidity, or you have these limit up or limit down markets, right? If the market continues to go limit down, limit down, limit down, limit down, it might be hard for you to get out. So sometimes selling those in the money put or in the money calls, knowing that you're trying to sell your contract, knowing that you're trying to get out, but you don't want to get out yet, but you could kind of finesse it in a way to be able to try to manage risk. And so, yeah, I'm right there with you. And then once you start seeing those signs that come out, once open interest makes a very pronounced directional shift, once you start seeing the commitment of traders report, and we talk about this all the time, once you start seeing that net long position start to get chopped down just a little bit more, but price continues to advance, but the momentum in that price move is not getting as aggressive as it was in the past, that's when it's kind of like we might be at a near-term top, right? And you can't really confirm that until it actually does top, until price tells you that it is a top. But there's, that's managing risk, I think, is everything. You can be a really great trader, but you can have a knockout trade. You can have a trade that goes up 100%. And that could be your nice, good knockout trade. But if 60% of your trades are losses because you have bad stop placement, right? That gain doesn't mean anything. So in the long term, managing portfolio risk management is definitely key.
Yeah, no, for sure, and that's well said. And I like the conversation and talking about that, because it's something that, I know it's a lot of fun to get on and we could just talk about cool things that are happening, but that's a huge part of trading. So I'm glad we took a sec for that. The Dave brought up a conversation on here, which is really cool. He asked some questions. If you guys do have questions, feel free to hit them in the chat. I know Twitter looks funny, but we do get them. I just can't message back. But looking at Dave's comments, which is March 2020 lows was another example when we were talking about capitulation. And then also April 2020 when crude went negative and equities bottomed in March. I think that's super interesting, because for me, I'm always looking at, and you're a guy like me, we're macro guys, and we kind of are always looking at the way things are connecting. And when we're looking at the way things are connecting, for me, if I'm going, okay, well, where's the market at in the bottom in March 2020? Well, we saw things like gold leading, basically anything that showed relative strength in the drawdown in March 2020, like semiconductors had a huge move off that bottom. And then gold had a nice move off the bottom, and so on. So it was that type of environment. And then we move forward and we see that capitulation in oil happen. And then next thing you know, oil's the leading sector or the leading commodity for a long time. We continue to kind of see those rotations in the market. So I like the idea of like kind of thinking of capitulation as a really important thing. Do you think oil right now, did we see a kind of bottom in oil at the moment? Do you think it can go even higher? It's moving nicely. We're up around, what is 82 when I last checked, maybe 81 right now. What are you thinking of oil right now?
Yeah, I would say from a structural standpoint, can oil move to the upside even more? I believe so. And you know this, Jason, but if I'm on Spaces or even if I'm on the Schwab Network talking about it, I think there's more of a possibility of oil ranging between 80 to 85 rather than this continued move to the upside, breaking through 90, going to, I'm already hearing people calling $100 oil, which that might happen, but I'm going to tell you right now, you're going to need to have a geopolitical catalyst in order for that to make that work, because OPEC pretty much has nothing else to give. Are they going to cut any more? Probably not. A lot of the chatter coming from the smaller countries, they want to bring production back online. Why is that so? A lot of the smaller countries out there, 80%, 85%, 90% of their GDP revolves around oil, right? So if they continue to take oil offline, that actually hurts their overall economy here. So I think that there can be a range-bound move. Could we hit between 85 and 90? Yeah, summer months, we could do that. It is possible. We don't really know right now what's happening with the energy companies and the refinery strategy going into the second half of this year. That's the biggest question mark. Now, we know that they're going to constrain the refining operations for the most part at the first half of the year. We're sitting at around 86.5% for the operating rates right now. Maybe that hits to maybe 90 to maybe 91 once we get peak. Are we going to hit 95 and 90, 96 and a half this year? I doubt it, unless something dramatically changes. But these energy companies have changed their strategy. They have that just-in-time inventory method or mentality like we see with grocery stores now. This is not the same that we saw 5 years ago or even 10 years ago. These companies have paid down a lot of debt. They're not stressed when it comes to trying to flood the market with actual physical supply of oil right now. Their biggest focus is returning cash to shareholders in the form of dividends or stock buybacks. Every single one of them has told you that. And I think that's going to still be the case. And now their production portfolios now are shifting to more domestic shale production, which there's a lot of rigs that you can put up. Yeah, they have a very quick like expense rate, if you will, right? These rigs onshore, the shale production, and they may last for 3 years, maybe, but usually the first year of production is around 60, expends around 60% of their total output, total planned output. So they're in a really good spot right now. I would rather see, so let me be a little bit selfish here, guys. If you are a trader and you're trading crude, you would rather see range-bound action at this particular level, in my opinion, than a continued rise to the upside that's not based on structural demand right now. The biggest headwind that's going to be in there for oil is what is each major economy reporting when it comes to their GDP, when it comes to their PMI, their industrial production, capacity utilization rates, things of that nature. If we do see a slowdown, which we are expecting one here in the United States, that's not bullish for oil either. European Union, we might actually have seen a bottom when it comes to manufacturing there. You want to see that expand. That is bullish. China has to have bullish industrial production numbers and bullish consumer demand numbers in order for us to be able to maintain this story. I think that's going to happen. I think that will maintain, but understand there's a lot riding to the downside too. There's a lot of downside risk that we could see in the event that something, and I don't want to call it a collapse, but if we do see us sputter along a little bit less than what we have expected here in the United States in the second half of this year, and say GDP does go down to, let's say, 1.8 or goes down to 1.5, or our utilization or industrial capacity rates a plateau at this point. That's going to be the biggest risk. And I'll kick it back with this. The LEI, leading economic indicators, that index that you and I were kind of talking about it about a month ago, where I said, hey, this looks like it's about 2 months ago now. This looks like it's about to be bottoming. It has bottomed. So that's a tailwind. So manufacturing looks like it may have bottomed in certain respects, which is good. You still need to have services still remain at a pretty decent level or be in expansion territory. So that's where I'm at when it comes to oil. If we look at a scenario right now to, let's say, July or August of this year. So if oil prices stay where they're at for August of to August of this year, that's all reflationary. And that's when you have really hard comps, right? I mean, that reflationary trade is one thing to kind of keep in mind. So yeah, oil can run. The drop in negative oil prices back in, 5 years ago, 6 years ago, just note that, yeah, there was a capitulation moment there. There was also a structural problem with that contract too. There was a couple of traders messed up. Yeah. And they thought that they were going to be heroes, and no one wanted to offset their contracts because there was no storage capacity to be had onshore or offshore. And these clowns had no idea. They didn't think they were going to have to take the physical contract. They tried to YOLO it. They tried to YOLO a trade, and they messed up. That's really why oil went negative. It wasn't purely capitulation. It was stupidity in somebody that doesn't know how to manage trading energy products.
And also, if you were in any of those contracts around that time, basically you were just shut out. They didn't pay you out -50, or something. They just you were shut out from that trade, which kind of sucked, but it is what it is. But looking at we got some great questions today. Thank you guys for writing in, especially on YouTube. Are systematic trading rules different for commodities? How does trading different commodities, copper, gold, soybeans, or heating oil? So I think he means, what do I use different systems for different commodities? It's a great question. Most of the time, no. There's one or two that might have a different characteristic that I might try to exploit, but for the most part, no. So when you look at commodities, the one thing that kind of sets out the commodities differing from equities is that equities are very mean reverting. When you're looking at equities mean reverting, what that means is that they revert to the mean, they revert to what you could say fair value, you could say, you know, moving average, whatever. You see a lot of chop. And the reason is, and I don't know this for sure, it's just I've noticed this through back testing, is that the news flow for equities is high. You can always figure out, you know, every day somebody makes up something. You know, I remember the 2018 was always funny because it was market up on trade hopes, market down on trade hopes. It was that way for a whole straight year. So like, you know, there's all this news flow in the equities market. But if you look at a commodity like cocoa, like what's the news flow really? Like there isn't much. Like now there is today, but in the early days of this trend and this thing starting, there isn't. So you see these very smooth trends start to happen. So I think it's really cool to just kind of look at that those characteristics to kind of build your systems and strategies. Because some people say you could trade them all the same. And I see people are successful in doing that. So I'm not to say that you can't do that, but I say like I trade equities one way, I trade commodities another way, I trade currencies another way, and I'll trade bonds a different way. You know, like I try to stick to the asset classes instead of the individual characteristics, and maybe like one or two things. Like Bitcoin is a great strategy for Bollinger Band breakouts or standard deviation moves or whatever type of strategy. While equities really are not. So, you know, you just kind of have to understand what exactly you're looking at and what you're trading and the characteristics behind it. That's why I always say it's great to go through something. You're trading oil and you're like, okay, if I'm in a trend for a year, what's the normal pullback in this? What's the standard deviation move? What's the implied move during that time, and so on? Like figuring that stuff out will help you to understand the characteristics of every single asset. And once you do all that, you can really kind of back test, and then you understand your strategy, and then you're kind of just putting your trades on and not really thinking too much. I hope that answered your question. So Kevin, we have a couple minutes left. I know, do you have something at 12:30 still?
Actually, I'm free until 1 o'clock Eastern.
Okay. Well, we'll go 10 minutes more or so.
Yeah.
So looking at what was it? Hogs. We were talking about hogs. That was the thing that we wanted to talk about a bit more. We got cattle, we got hogs. Both very interesting markets. A lot of setups. You know, we also have a seasonality model that basically is pointing to hogs usually have a ripper in April. And the fundamentals are kind of backing that up at the moment. So Kevin, what are you seeing in the hogs market at the moment?
Yeah, so for hogs, all right, so we have a seasonal factor that's taking place right now. So we are seeing a situation where hog production right now is on the decline. That's not a negative thing. That's a seasonal thing. Usually we do see production of hogs kind of going to the downside, but the real key area that you really want to focus on is going to be the delivery numbers, what the actual delivery what the delivery numbers is for pork and hogs at this point. And actually that continues to move to the upside. So spot prices for pork cuts continue to rise on pretty much a day-by-day basis if you're looking at the cash market, and that is actually key. And you're also having some data points here that I actually was looking at in a report. We had the cold storage report that came out yesterday, and this is actually why we are seeing this move in hogs today. Hogs are up about 1.3% here because the cold storage actually did have a drawdown. They showed that cold storage was sitting at 5 million pounds of frozen pork in the month of February. And that was actually down from 463.3 in January. So what does that mean? If you have lower supply of frozen pork in your inventory, that means demand's higher, right? That means prices kind of go up. That supports the price narrative. Hog supply will actually increase this year. Be mindful of that, but there is, once again, there's a structural shortage that is actually taking place in the hog market, and I think that's going to potentially support price at this point in time. Now, when we talk about the seasonality factors, just kind of note from May to from the start of May to about the end of May, we typically do see a sell-off when it comes to hog prices, because a lot of that supply is starting to hit the market. And then that's kind of when we see, once again, a bid back to the upside here. So I think seasonality wise, you may have another month or so to continue to see prices staying at these levels or continuing to advance higher before we see a drawdown in those prices. You got to keep your eye out on the spot prices, the cut prices, and those continue to rise, even if you see a little bit of a disconnect when it comes to the hogs themselves. And the reason why I kind of bring that up, let me transition here real quick. Live cattle is experiencing that. And Jason, we were talking on Friday. I was laughing myself over the weekend. We were talking about cattle on Friday, and I was like, man, everything from a technical standpoint is, it wants me to just press that sell button. It seems like it's something to short. And we are seeing a little bit of a pullback right now. That is a pullback that I don't think is going to be sustainable right now. Maybe we have another trading session that actually does happen. But once again, you go to that cold storage report, and we actually did see the cold storage for cattle came in, or for beef basically came in at 442.7 million pounds for February. That was down from 471.2 million pounds for January. Now, year over year comps, not as great. But once again, there is a signal that physical demand for cattle and beef products are still there. There might have been a little bit of a disconnect when it comes to the prices, but I think there is a seasonal factor that's going to be in place. And I think I misspoke on Friday too. The impact of those fires that we saw in Texas, right now the count is at 10,000 heads of cattle right now. And that continues to increase. And there's the USDA has a program out there to be able to help out with those that have been impacted here. But once again, and then there's also the situation too, where there's bird flu in cows, milking cows, which also could actually impact. It's not funny, but it's not having an impact when it comes to actual milk, because that flu is being killed throughout the pasteurization process there. But once again, it could actually have an impact when it comes to overall supply there. And then the seasonality factor, demand for beef typically goes up this time of year, grilling season and things of that nature. So I think these prices for the most part may be able to sustain themselves. If you're looking at cattle, could it go down to, let's say, 178.5? I think that might be something that's doable. And you have the price chart up there. I'm not sure if that's a daily chart, but you could see where the uptrend is. And if you, Jason, can you go on a weekly? Boom. That's a weekly chart, right? That's probably over the last 3 years or something like that.
Yep, that's all the way to the bottom in 20.
So you can see where the price action is. And this is the last thing I will say here. Ranchers, and this is going to be for farmers too, but ranchers have had a very difficult time over the last 5 years, guys and gals, when it comes to trying to raise cattle and raising lean hogs. Their input costs when it comes to feed has gone up astronomically. If you're looking at fertilizer costs and the input cost that goes out there, they've gone up astronomically on the spot market. And we also have a situation of drought that has been taking over pretty much the better half of the growing population or growing area when you're looking at live cattle and lean hog production. Even here in Colorado, we have a very large cattle business here. So a lot of these ranchers were very stressed because either it got too hot, which we would see a significant amount of deaths, right? And cattle's not being able to survive. You have a drought where you're not being able to provide the water, and it costs money to bring water in and trying to obtain water rights. So a lot of these ranchers said, you know what? If I can't go for quantity, Jason, what do? Go for quality. So I'd rather have one cattle that's going to just be really nice, really juicy, be able to have all of the nutrients, instead of having to have 10 cattle that I'm just trying to throw grain at, and hopefully they make weight. And if they don't make weight, and you don't have that margin ability between pounded and the amount of pounds that you could sell in dressed weight and things of that nature, then there's a problem. That's structural that I don't think is going to abate anytime soon. Every rancher that I talk to, everybody that I see at auctions are saying, look, this is the strategy, and this has been a good strategy for now. And I think they're going to continue with that. And that's why you see that price trend to the upside. Structural in nature, just like cocoa.
Yes. And I think it's generally, there's just so many products out there. And I think so many people don't want to get into all these ones. I'll run into people and they'll be like, well, I don't know enough about hogs to trade it, or I don't know enough about cattle to trade it. Now, once again, like dependent, and I'm talking about people who are say they're price action based, they're quants or they're technical traders. Like whatever you are, like if you understand that you're a technical trader and you will trade any stock in the stock market based on technicals, you can do the same thing in the commodities market. But you really like once again, it's a understanding the structure is I think more important than even understanding the commodities. Understanding the futures market, understanding how contracts work, understanding expirations, understanding the options and of the underlying contract. All of these things are incredibly important. So, if once you understand those things in the futures market, then you can really kind of hop in and use all of these different products because it adds a major level of diversification. You can think of the trends you can have in things like cocoa and sugar, and you just showed cattle. Hogs is another one. So, there's so many things out there to trade, and I really like the idea. Kevin and I really enjoy covering the commodities markets, and so we're going to be doing that a lot. And it's just something that isn't talked about enough, and not enough people really trade it on a fundamental, technical, or quantitative basis. It needs more people involved. So I think this is cool that we're covering that stuff. So let's do one more quick overview, Kevin. I kind of wanted to just talk about the macro state that we're in today. We're seeing all this macro action. We're talking about the commodities. We're talking about how that affects the market. What exactly, when you say the reflation trade, obviously I know what this is, something we talk about all the time, but let's explain it for the people out there. What does a reflation trade kind of mean?
Yeah, so you're looking at assets that actually could increase or appreciate in value once again. And when we talk about the reflation trade, normally when you have an expanding economy, right, or you're trying to expand in the economy, what does that entail? An expanding economy entails that you're going to have increased demand for anything, right? It could be services based, it could be goods based. Well, in order for you to have that demand, you're going to have input costs that are there, right? And the input cost is really what we're talking about, the commodities in general, the base stuff that's needed in order to transform them into final goods, no matter what it is. If it's soybeans, it could be actual soybeans, it could be soybean oil, it could be soybean meal. If it's oil, it could be gasoline, it could be heating oil, diesel, it could be naphtha, it could be plastics. People don't really think about it. Crude oil, petroleum products are literally in every single thing that we use on a daily basis. You could be the most ardent person against oil and fossil fuels, but guess what? That phone that you got has fossil fuels in it. So everything that could actually see demand going up because of expanding economies and things of that nature need raw goods in order to transform them. Those raw goods then see demand going higher. That means prices go higher. That means inflation goes higher. Now, when we talk about this, that doesn't mean that it's a bad thing. And I always bring this up. Inflation is good for equities. Inflation is good for the economy as long as you have wage growth that accompanies that inflation and your wage growth increases or is more than the inflation that you are seeing. If we have 4% average wage growth in the United States here and we have 3% inflation, that's net positive. That's also going to be showing up and reflected in GDP numbers. So that's kind of what we're talking about. A situation where you have demand going up and then the demand for the input goods also going up. That could also be supply-based driven too. Like, let me mark my words here. So you could have supply issues in the market and where demand stays steady and then prices will still go up, right? So if we have good output when it comes to gasoline on a weekly basis, we can do, on a daily basis, we can churn out, say 9 million barrels of barrel equivalent of gasoline a day. And let's say then 4 refiners go offline and that 9 million then goes to 6 million for whatever reason, but demand is still at 9 million barrels a day from a consumer standpoint. Prices are going to also go up. So this narrative or this thought process is not only just supply based, but also demand based. And I think right now, the reflation standpoint that I'm looking at is the fact that supply chains in certain respects when it comes to the commodity markets are not ready yet for an expansion of growth on a global scale, including what China is doing. A lot of the prices that we are seeing is ex-China at at 8% growth on a GDP basis, which is for the most part actually normal, 8.5%. They're growing at what, 4.5% right now. I mean, they're not even close to where they need to be. And this is where the prices are at right now. Imagine that demand continuing to move back to the upside here. And actually, China, if you look at it, their import numbers are actually already moving to the upside. We just haven't seen it in their final like GDP numbers yet. It might take a couple of quarters, but they're ramping up already. And that ramp up can then also move prices higher. That's that reflation trade. That's also looking at some of the other parts of the market, utilities. If you're looking at the energy companies that we talk about, if we talk about the ag businesses like ADM, or if you're even talking about services based, and people want to start, the recycle process happens for the iPhones again, right? And Apple sees a bottom. Where's that production going to come from? It comes from the raw goods, and that is inherently inflationary in the long term. So that's what I'm thinking about it. What do you think?
I have nothing to add. Honestly, you explained that in a fantastic way. When I'm looking at the reflation trade, I'm also always thinking of the regime of where to invest. And so, the last update we just put out on our newsletter, which was we were just basically talking about where we want to continue to look, like energy, obviously being a place you want to be in this type of environment, industrials, materials. These sectors do great in these environments. There's also sector futures if you are a futures trader. So I trade the sector futures a lot. They're really great products. And then if you move forward into, the commodity space, these growth-based commodities like Kevin's talking about, we're looking at those starting to move. These are all areas that we're going to see some movement in, and we need to continue to pay attention to it. Continue to also know that the fundamentals will continue to change as the trends of these continue to change. So I'm also always looking at the market being a little bit more forward looking. So now we're kind of seeing this kind of setup and going, okay, well, this copper thing here, let's see where this ends up. This oil thing here, let's see where all these things end up. So really, like, kind of understanding too is that I don't really want to be long bonds right now. I don't think it's the right environment. I think a lot of people are very interested. If the Fed starts cutting, sure, I'd be more interested, but at the moment, it doesn't look that way to me. I'm not seeing that. So I don't want to be in bonds. I want to be in countries also is another good thing to talk about. There's commodity-based countries. You want to be in the commodity-based countries right now because those are going to be the ones that are going to be the big winners in this type of environment. And you can take these strategies that we're talking about and kind of boil it down to, okay, well, maybe you're a stock picker. You're not like me. I trade the sectors. You can go into those sectors and then find individual stocks inside of it and so on. But that's a type of environment that we're kind of seeing. So I really try not to, there's two things I don't fight. I don't fight the economic regime, and I don't fight the trend. And so between those two things, I can kind of usually be on the right side of most trades. There's not anybody who's right all the time, but it puts me on the right side and the right path to continue to make money. And I really like the way like a lot of these things are looking, as I'm looking through all these, country ETFs, there's so many country ETFs out there. You're looking at the ones that are commodity based that are doing well. Saudi Arabia, obviously being one of them. Let me go through the year to dates. So Israel's up 10%. Japan obviously has been really leading the way. So many people haven't been talking about it because honestly, the fundamentals for Japan don't look that great. The demographics don't look great. Nothing looks great. But what I think about Japan and another way to look at it is when the market starts to bottom and turn up in Japan or before ours, usually that's where the bottom in the market happens. Also, when Japan starts to top and turn down, this is when the tops in the market start to happen. So I kind of look at Japan for two reasons. One, it's a trading vehicle. The other reason is it can give me a hint where the market direction is. Right now, everything's screaming this reflationary style regime that's very risk on at the moment. So, it's a very good time to be long, but also you have to remember like these type of regimes usually end up in a melt up type situation. That melt up type situation starts to put too much pressure on the entire market, on the economy, on everything. So I know that this is a good environment to invest in, but I also understand that this is an environment that bad things can happen at some point. So I need to put both hats on be long, but also be a risk manager at the same time. You know, you're not going to make any money if you just sit out and go, okay, the market's going to go down all the time. But also you're not going to make any money if you lose all of it because of some major pullback, you know. So keep paying attention to that. I think the regimes kind of keep us on the right side of the trade, and that's all we can really do. And so let's continue to be on the right side of these trades. So far, the year has been going great for anybody that's a trend follower, commodity-based trader, and so on. And we'll see where we end up. But yeah, there's just so many good countries to invest in, so many good sectors, so many things that are just starting to move. Like, it's kind of exciting, you know, because it's been a very tech-heavy regime for a while here.
Yeah.
You know, and that's the funny thing. We go on these talks, and everybody's still on this, like, well, tech forever. Like, it's the same conversation over and over again. It's like, well, it's just not how bull markets work. Bull market.
And actually, you have your year to date. I have a new platform here, so I have to reset it up. What's the year to date for tech right now? If you have that
for
up.
tech, let me look. Year to date, XLK is 8.62.
Okay, so 8.62 year to date.
Yep.
So, and I know you did it earlier, but let's just put it in perspective, because we get a lot of heat when we talk about commodities, and people are like, "Oh, dude, what? Who cares? Tech." You said 8 point what?
8.6.
Okay, so let's go back to those commodities that we were talking about earlier. I know you had your list up here, and just rattle off a couple of those popular ones: the gasoline, the crude oil.
Oh, I'm bringing them up. I'm bringing them all up. Let's put them on the screen.
We can have these conversations, and sometimes you have this echo chamber that's taking place where people are like, tech. Now, certain areas of tech, by all means. So let's check that one out.
So there we go. You know, we got cocoa at over 130%. We got Japan over 20%. We got orange juice 20%. We got crude oil 15%. You know, like, basically down the list until you get to the S&P 500. Actually, they're all beats. You know, they're all beating it. So at the moment, it's like you can find so much diversification in commodities. I don't understand why people don't look at it. Not to mention, when I'm in something like there's years like 2017 where like the commodities are very flat and the equities are up. So I really like being in all of these things. I like being in the equities because there's that diversification factor. And then there's years like 2021. I had one of my best years ever in 2021, and tech investors didn't do that well in 2021. It was very hard to pick individual stocks. Breadth was bad, but the commodities were raging, and the commodity-based sectors were raging. So that diversification is going to really give you that massive outperformance, not to mention it's also going to help you to manage risk, because if you're just in like, if your performance is completely based on how Apple is doing, you're stuck with that. But, you know, for me, cocoa could fall off of a cliff today and my performance in something else will probably take over. And also I have the ability to be long and short things. Commodities trend like nothing you've ever seen in your life, up and down. So we're really looking at this type of environment. It's a good environment to start putting your hat on and start thinking about all these commodities and try to figure out, hey, where do I want to be positioned going forward? Kevin.
Oh, yeah, so good.
I had a great question on here. I don't want to forget it before we get off. Sure. Understanding contango is really important. Any view on NG? And so I want to first preface this way. The first time I talked to Kevin and was like, hey, I got to get Kevin on my show, he was talking about this on a Spaces, and I was like, oh my God, I'm actually talking to someone who understands futures and commodities. And like, he had a really good outlook, basically said, hey, this is in the front month. Hey, we're going to see this end pretty soon, and was spot on about it. So Kevin, you know, what are you seeing here? Perfect person to ask this question to. And natural gas.
Yeah. So, one thing to know. So those that talk about tech, and then we talk about commodities, and if you look at it from a margin-based situation, even if you're looking at crude at 71 going up to 70 or 81 and some change on what, $11,000 margin, and that would be $11,000 margin, $11,000 profit. That would be 100% profit on the commodity. So you can't even go apples to apples or apples to oranges when it comes to overall performance. But I'll take 100% on a crude contract any day over a tech right now. Natural gas, there's a lot of people that want to be heroes in this particular trade, and it's a very tough one. So you brought up contango. So contango is basically where the front month is actually cheaper than the forward month. So if we are in the May contract right now, it's trading at $1.79. The next month is going to be the June contract. It's trading at $1.80. So that's contango. Think of contango. It's just a fancy name of saying a normalized market. You also have something called backwardation. Backwardation is where your front month is priced higher than your futures month. That just indicates that demand is actually higher near term than what we are seeing for the future contract. That's what we are seeing for crude oil, Brent crude. It's in backwardation. It's been in backwardation for darn near almost 3.5 years overall here. No one wants to store any oil. So this contango market that we have in natural gas, there's a lot of people that want to be heroes. I kind of bring that up. And I say this, and I'm not trying to be like, oh, what a wide range. Between now and July, natural gas will spike. I can tell you that will happen. Do I know when? No. But the probability of a geopolitical event or a weather-related event to be able to spike natural gas during that time frame, go back every single year. Every year it happens. They don't last, though. They're not sustainable, and that's unfortunate. We have inventory levels that are at 15% higher than what our 5-year average is right now. And I think on the 10-year average, it's even higher than that. The European demand and European inventories are at really high levels compared to what we would have expected, especially during a war right now. And that's because we've just had mild winters across the board. So now we're getting into injection season, meaning we are going to refill the inventories that are already pretty much overfilled in the market. So that's also putting downward pressure when it comes to the price of natural gas, which is fairly tough right now. Also trying to keep in mind when you're talking about the crude oil revolution, the shale revolution that we have, the byproduct of that type of operation is also natural gas. So if you have an increase in production for crude, you're going to also have an increase in production when it comes to natural gas or when it comes to the supply there. So much so that if you look up north in that Bakken region, there's a lot of operations up there that just burn it off because it's not economically profitable for them to actually condense or try to transport or build out the pipelines to be able to try to ship that natural gas to where it needs to go. Once again, if you want to be a hero, then by all means, try to be a hero with it. If we talk about the seasonality effects, though, natural gas, you'll start hearing me talk about it as soon as it gets to September of this year. I did it last year, September, the year before, September. Why? We have that seasonality factor, and you have the weather trade that can be associated with that. Same thing when we're talking about seasonality for heating oil. Unless we see a huge increase in when it comes to transport demand, I'm probably getting, gasoline is going to be a little bit more attractive in the summer months than heating oil is for the most part. But if you talk to me in October, guess what I'm going to say? Heating oil is going to have a better opportunity because of its application there. Natural gas should see price pressures in the summer months. The question now, though, Jason, is how low can it go? Because we're really close to historic levels already. We're only about 20 cents away from very historic levels. At a point where we're starting to see a lot of these companies, EQT, taking operations and rigs offline, actually. And I believe we actually did see a pretty substantial drawdown in rig count from Baker Hughes last week. So bearish for the most part for Natty. When do we find a floor? I can't call that for you because I've been trading natural gas for the last 7 years. And I still have not been able to call that floor. And this is the only contract that will just destroy you. If you think you have a bull case, unless you have a long enough time period, it will destroy you in the near term because of the chop. And that's not a recommendation or advice. I'll kick it back. You can look at utilizing UNG as an ETF. Okay. You can look at utilizing UNG. You can look at going out and say the November contract. I believe they might have November's up by now. You can go to the November contract. You can buy that long call for that November contract. You can then come back and sell call premiums against that, right? One standard deviation out. you're going to be picking up pennies, but pennies add up to dollars. And once you kind of get that, let's just call it, basically you're just doing like a calendar spread or diagonal spread. Once you get to that point where you do have that spike in IV and that spike in price, that's when you're going to be able to be profitable for it. That would be the only way to really play that natty gas trade right now, just based on the fundamental dynamics that are in place. Jason, what do you think about it?
Yeah, I mean, so there's so many different things, and it's multifaceted. One, I found the only way to profitably trade natural gas is really to be systematic. You know, for me, that's what gets me in and out of the trades. I've had some great trades. I have people always telling me, "Man, you really understand natural gas like nobody else." It's like, no, I don't. I just I have a breakout. I follow it. You know, like basically, I also, the reason why I've survived as long as I have, because I think that's the thing that isn't said enough. When you survive a long time as a trader and you don't blow up, you have a chance to learn and understand things.
Mm-hmm.
My understanding of natural gas is just because I've been around for a while. I understand that it is the most volatile, bipolar product on Earth. And because of that, I need my position sizes to be really small. I'm a futures trader, so I have plenty of leverage. I use no leverage on natural gas. I trade very small positions. I have very wide stops because the volatility is very high. Just a pullback within that last uptrend that happened, you know, let me measure it right here. Normal pullback, 35%. 35%, you know, so like you have to have these very small positions, very wide stops. Normal pullback in the middle of a trend is 35%. That's like Bitcoin. So understanding this, and it's choppier than Bitcoin, so it's a lot more pullback, a lot more volatility. So I think the thing why people get killed so much in natural gas is they try to trade it like they're trading a normal stock, you know, or the S&P 500. You just can't do it that way. So you have to trade very small. You have to understand that like I have plenty of seasonality models, and like Kevin said, you know, the seasonality going into the end of the year, like basically August, September, and October are usually pretty good. And that's true. But also, I can also say I've seen the opposite scenario play out some years because natural gas doesn't care about anything. It just goes every which direction. The correlation to the reason why I think it's a very important thing for people to add in their portfolio is the correlation to everything else you're trading. It's the only thing that like is so uncorrelated to everything I've ever traded that I have to have in my portfolio to add that diversification. But once again, it's a very hard to trade product. If you understand it, you've been trading for a while, because I don't think you have to understand everything about everything you trade, but you really do have to understand the volatility of the product you're trading. If you don't understand that, you can't set up your position sizing right. You'll trade too big. You'll blow up too quickly. You'll hold on to position like commodities. Like somebody had a conversation with me the other day, and they were like, "So where exactly can natural gas go down to?" And I was like, "Well, exactly, I have no idea." I said, "Nobody does." It could go back to $1 today. It could go up to $10 tomorrow. I have no idea. Natural gas is the wildest product anybody will ever see. But the thing that you have to just keep remembering is, okay, I'm going to understand the volatility of this product. I'm going to trade its very small positions. I'm going to be systematic about my entries and exits because it's going to do whatever it wants to do. This is the only product I've ever seen in my life that has gone like it had these massive pullbacks in the middle of the craziest uptrends you've ever seen. They're like bear market pullbacks in any other commodity or product, and they're just a normal uptrend in natural gas. So it's a wild one, but you know, there's so many different ways. But we are seeing that you know, for me, we have a system that gave a buy signal. We're still sitting in that trade. It hasn't made any money. It's lost a couple bucks already. And then, you know, we're getting into April. Could be a good move, but once again, if I get a buy signal, whatever, the seasonal based or whatever, I am going to take that trade. I'm going to have a stop loss there.
Yeah, you got to fade it real quick, right? I mean, the pops that you're talking about, outside of the geopolitical events, the pops that you look at may last for what, a week, maybe last.
And that's the crazy thing too, and that's the thing, you know, we're talking about here is when you're seeing that in the front month contract, like what you were saying earlier, you know, most of the time that's a supply issue. It's something that's very short lived, and you know that's what we're kind of seeing lately. I haven't seen it turn up in the later contracts yet. So once we start to see that, I'd be a little bit more interested on a fundamental basis. But for now, it is, why I take all my signals is because I'm proven wrong a lot compared to my systems and strategies. Years ago, I actually was like in the middle of trying to figure out, should I be systematic or should I be discretionary? And I actually traded half of my portfolio systematically, half discretionarily. And so when I was doing this, I realized my systematic portfolio was kicking my ass, and then my my discretionary portfolio was just kind of treading water. And I was like, okay, I put so much time and effort in my back test, I need to start actually trusting them and doing it. So I will take the trade, it's on. But I also know there's not much fundamental reason to take that trade. But I could say that at a million things that I've traded over the years that have been extreme outperformers. I can't tell what the market's going to see in the future, but for now, it's just the systems tell me what to do. And also my portfolio is set up in a way that if I lose on this trade, I'm only losing 1% of my portfolio. That's kind of the key here. So cool, man. Well, I
Could
know
I
we
just add just one more thing,
please,
just
please,
real
please.
quick?
I got time.
There is a bull case for Natty. And the reason why I brought up November for that contract, if the Biden administration does reverse its decision and does allow the expansion of LNG, because a lot of people think that the Biden administration stopped the exporting of LNG. That's not the case. They just stopped the future expansion, I believe, up until 2028. But they said that they're reviewing it. And this will become a hot button issue once we get closer and closer to the election. And based on the geopolitical events, right, wrong, or indifferent, LNG is actually a really good geopolitical lever right now for the United States that no one has ever expected, ever. And if there is going to be some form of a re-escalation in tensions, and there already does appear to be in certain respects in Ukraine, Poland, Belarus, Moldova, all of this stuff, they may need those LNG imports for the winter months. If the Biden administration reverses that decision and says, you know what, we're going to allow for the expansion, party on, that's where you can get your bid. The money is not in gaseous flows for natural gas. It's for liquefied natural gas, taking that gaseous form, condensing it down to 600ths of its size, packing that bad boy into a ship, and then basically re-expanding it out and putting it in the storage to wherever it's going. And that is the most economical way to transport natural gas, no matter how you slice it. Think about 600% increase on that inventory. So that is the bull case that could see some rapid expansion. Or if you do see the Trump administration getting in, and maybe they do reverse their decision as well. They weren't too hot the first time around when it came to LNG, though. So let's not get it twisted. Both sides really have seen a lot of downward pressure when it comes to trying to expand these operations. But it could be an election issue, which is why I'm saying November, if you were to make a play for Natty, you go out, you buy the time, you sell the premium against it, you wait until that time gets closer and closer, until that pressure where it could be a decision where that could be your thing that breaks out Texas, basically, because that's what we're talking about. We're talking about Texas. Yeah. That's a battleground. You might have to make a concession. He might have to make one, and that might be one that he makes, and that could be that bullish case where you do see a little bit of a bounce for Natty. So I wanted to add that in there.
No, that's perfect, because to me, this is why the price action is so important. If we look at, the price action of a product, why does that matter? Like people always act like technical analysis is either like witchcraft or something, and really it's just the idea of studying what's actually going on. So for me, sometimes I'll notice like there'll be no news around some event, and all of a sudden you'll see something moving, and then 2 weeks, 3 weeks later something comes up, or even a year later. It'd be very interesting to see, hey, there's somebody who knows that exactly what Kevin said is going to happen. And so that might turn up in the price action way before it turns up in the fundamentals. Things like this happen all the time. It's not that I'm saying there's manipulation or market manipulation or anything. If you trade and feel that way, you're going to lose money because you just get disheartened and you think there's no way to do this. What I'm saying is that somebody somewhere knows information That's why the market works the way it does. As they know this information, they might think natural gas is a great buy. They might start buying it, around now for who knows what reason. This could show up in the price action. Then we see a breakout. Then we see it change trends. All of a sudden, it's a buy. So once again, it's looking at the price action, understanding this is why I like talking to Kevin, the future fundamentals that could come into play and how important those could be and where we end up from there. So great talking to you today, Kevin. I know you got to get going. Thanks for being generous with your time.
Always a pleasure, man. And have these, if you guys like this stuff, man, we're trying to do these a lot more often. So if you're feeling it, by all means, put those comments in, let us know. And I always appreciate you giving me a platform to be able to talk and, dissect these futures markets, dissect these commodities, Jason. So I really do appreciate you, man.
Of course, man. You're anytime, dude. I love doing these. I'm so passionate about doing these. And same, please, follow Kevin, KG Bull and Bear. My name's right on there, so you guys can follow me if you like. But definitely come on and let us know, if you guys like this, because we're trying to do these a lot more. And the more comments we get, the more shares we'll do these as much as we possibly can. So, all right, guys, take it easy.